What's up, everybody? This is Big D for the Freedom From You and Me channel. Today is May 11th, 2009. I haven't made a video for a while. My computer at home has been overheating a little bit. My laptop, so I'm here at the real estate office and decided to make a quick video. Real quick, something came across my desk today. This is the new, for this month, I don't know if you guys can see that or not, Realtor Magazine. Okay. Inside this magazine, there's an article talking about, where's that? Right there. Can you read that? There we go. The year of distressed debt. All right, watch this. Now, it says in this article that with an estimated $400 billion in commercial real estate loans coming due by the end of 2009, we're in some serious shit. So what's this mean? All right, here's what's going on. For those of you who keep hearing about a commercial real estate bubble it's gotten a little bit of play, but they're trying to keep it down and quiet. We're looking at $400 billion within the next 6 months coming due. That's a lot of freaking money. So in that 6 months, so let's call it $1 trillion for this year, for 12 months out, 400 billion, whatever. It's always an estimate. It's always low. Bottom line is, here's how this works, okay? Follow me here. You have $1 million property. Let me back up. A friend of mine, who I've done business with here, has got several shopping centers that he's partnerships in throughout the country, about 15. And he's having, I'm not going to say the companies that are giving him issues, but he's having issues with these guys coming back to him and saying, these guys meaning companies coming to him and saying, well, we're in financial straits, so we are going to renegotiate our lease even though we have 7 years left on our lease, signing a 10-year lease. Take this money or we're shutting the store. So, you know, you're kind of up against a hard spot here. So what do? Do you take a reduction in your rent and keep the building full, which most people would, and especially in this times? Or do you run the risk and let them go vacant? You know, they could be vacant for 2 or 3 years. You know, we've seen that in Central Illinois before. So, and that was in decent times because commercial is always fickle. So, if you agree to take, if a commercial property owner agrees to take less rent, commercial appraisals work like this. They take the value of your income, your gross income. They whittle all that down. Then they get to your net operating income. They take that into a gross rent multiplier and figure all that out. Bottom line is, they take your money, how much you make per year, how attractive is that to an investor. So then they figure out, you know, if you're making X amount of dollars, they take that, and that's how they figure out how much your property is actually worth. It has some to do with the aesthetics of the building, but primarily how attractive is it to another investor who's going to be purchasing that property. So now you're taking less money for your lease rate. Okay, so now the banks are typically requiring, you know, they don't want you to go above 80% loan to value. Okay, so if you have $1 million building, they want you to have $200,000 in it for an $800,000 loan. So you have an 80-20 split or an 80% LTV loan to value. Well, now banks are requiring 65 to 70% loan to value. So on that same $1 million building, you now have to come up with $300,000. Well, if you have a commercial property, and a lot of these banks went to 5-year balloons, so which means at the end of 5 years, you don't have the opportunity for an adjustable rate. You have a balloon. You have a deadline. Your loan's expired. You have to refinance this property, and you have to come in and give us all new information on your building, what your building's worth. And that's what this magazine's talking about a little bit. It's saying we're going to have $400 billion here within the next, by the end of this year, coming due. So now you've got less money coming in on your building, which then your net operating income is lower, times your gross rate multiplier, cap rate, whatever it is you want to call it. Now your building's worth less. Okay, so originally you had $1 million building. You had $800,000 into it. So now the banks are saying we want 70% of your building. If your building's worth now $800,000 because you're making less money, now you have to come up with an additional $250,000 to get to that 70% loan to value. See, so if Building originally was $1 million. You had the rents to back it up. You had to come up with $200,000 to get your 80% loan to value. Okay. So now that you've agreed to take less rent, your building's worth less. That's how it works in commercial. And these companies know this, and they're coming to them and negotiating out the leases again. So now your building's worth $800,000, let's say. So now the banks are saying, all right, well, you're at 100% loan to value right now. You need to come up with 30%. So now you have to come up with $200,000, $300,000. It ain't gonna happen. You know, and people who typically own commercial buildings own more than one. You know, once you start getting into commercial, I own some commercial buildings, very few, mostly 12 units and whatever, mostly apartments. But I own a couple commercial buildings. You know, people are not going to be able to come up with, and that's on $1 million building. Typically, if you have these larger shopping centers, you're looking, you know, anywhere from $10 to $50 million. So, you know, these guys are going to be required to come up with a lot more money down. Well, how the hell do you do that when you have less money coming in? You can't. You follow me? So, you know, he got another letter last week from a clothing store, which if I said the name, you would know it. I'm not gonna go there just yet until it becomes public. He got a letter from these guys saying that they're going to declare bankruptcy. And just letting him know, because they do have a store in one of his buildings, and you know, they owe him money, and it's just not a good deal. So there again, you have a building that's now worth less. So it's a domino effect. You have less coming in. You can't come up with the money that the banks are going to require for the additional 30% down because you're making less money. See, the dominoes have fallen, right? And the banks know this. So on top of that, the banks are charging everyone astronomical amounts of credit card interest to help cover this loss that they know is coming. So it's not going to get any better. It's actually starting to get worse. So I just wanted to give you guys that quick little rundown. I just got this across my desk today. I appreciate all the new subscribers. Thank you guys. Thank you for all the emails. I do try to get back to everybody. It's been interesting. It's going to get a lot more interesting. You know, one thing that you guys need to watch for, it's not getting hardly any media play on a side note, is the fact that the United States government's contract to oversee or to look over the internet expires in September of 2009. So Jay Rockefeller and Olympia Snowe came up with a Senate bill. I think it's 773. I'll post it up on the side link. You know, basically, they're not too sure about this whole internet deal. You know, some changes are happening. We'll make another video about that. I wanted to try to stay on point with the commercial side of things. So watch for this, because the third quarter is going to be very important. Because lease rates are going to go down. They were expecting a huge, massive bump in the fourth quarter due to Christmas last year. It did not happen. So now these stores are scrambling to help cover their costs and overhead, because they're stuck in, you know, anywhere from 5 to 15-year leases on these buildings, and they know they cannot pay for it. So it's coming to a head now. You know, my guy's not a huge guy. He's in a partnership with some other guys on about 15 shopping centers around the country. Just wanted to give you guys that little heads up. So if you know what's happening to him, you know what's happening to the big guys. But the banks changed the rules, and they're requiring more money down, a greater spread between the loan to values. And when these balloons come up, and they're coming up now, you're going to see a massive, massive bubble burst. And it's coming, and there's no stopping this thing either. And the banks know it's here. So welcome to the truth, you guys. Please rate, comment, subscribe, the whole nine. Appreciate everything, and we'll be making more videos soon. I just wanted to drop a line. So God bless. Take care.